The 2026-27 budget update. Joining me, my name is Brett Griffiths, Director of Superannuation Advisory, and joining me today is Belinda Crowley, who's also a Director of our Taxation Advisory team. Thanks for joining, Belinda. This is I'd like to say, a fairly monumental budget that we have this year, certainly compared to most recent years. Now, thankfully, Belinda will be doing most of the heavy lifting on this one, but I'm really just here as a bit of a support. Now, it's important to note that while we've spent a lot of time going over the budget and not a lot of sleep, you basically can't believe anything we're saying unless you're speaking to us directly on your particular circumstances. In this budget, we're going to be talking, or in this presentation, sorry, we're going to be talking about setting the scene, so a little bit of an economic touch, because that's what I like to do. Talking about some personal tax. Belinda will focus on the business taxation. I'll touch on super, and we've also, right at the end, we've just got a couple of other little bits and pieces. So with no further ado, let's get into it, Belinda. So essentially setting the scene. I think this is really interesting as to where they're essentially predicting GDP, unemployment, and the CPI to land in the next, they call it the forward estimates. So basically, that's the next 4 years. So what they're really suggesting is that they're expecting GDP growth to be to be reasonable, but the scary part is the CPI, which is going to be around 5%. So not a month ago, the RBA predicted that CPI would be around 4.5%. Treasury are forecasting we're going to hit 5%. Now, a little interesting side note is that the word uncertain was mentioned 54 times throughout the budget papers, and that's all because of the war that's going on in the Middle East at the moment. And Treasury have actually done two forms of modelling. One form of modelling where oil prices are $120 a barrel, dropping down to $80 a barrel over the next couple of years. And then another estimate where it hits $200 a barrel and then decreases from there to around $120 a barrel, I think it was. So that really goes to show the uncertainty that Treasury are putting on the numbers that they're using, simply because no one really knows what's going to be happening. If that war continues, then it will certainly impact our CPI, obviously our GDP, and therefore potentially our unemployment rate. So unemployment, they're essentially expecting to be fairly flat, but once again, time will tell. And not much in the way of wage growth other than what we've been having the last few years. This one here I thought was rather interesting. So this is a little graph I've put together showing the share of revenue the government receives from 2006 right through to what they're estimating for 2028-9 financial year. So essentially, the top line there is individual tax rates. They're basically saying that they're budgeting for the individual, the share of revenue received from individuals to go from 44%, which it was, 42%, which it was back in 2006, up to 49% in 2029. That's a massive increase in revenue. Remembering that overlaying that is we have an aging population, and our participation rate is in reality declining. Without immigration, we're going to have a lot of troubles maintaining our government standards, I suppose. And during that same time period, the GST has gone from 15% down to 13%, which really goes to show that the skew between those two numbers are quite wrong. So they're talking about this budget being the biggest tax reforming budget for many a year, which in some ways is true. However, unless they're considering everything, which includes GST, it isn't tax reform. It's more just changing tax rules. Those that are unfortunate enough to listen to the podcast, this webinar over the past few years around the budget will know that this is a bit of a beef of mine, that really there's no tax reform unless they consider every form of tax, not just what's popular, essentially. So anyway, using that as a little bit of a backdrop, quickly touch on some saving measures. There's been a lot of talk about the NDIS savings. So $37.8 billion over the forward estimates, so those 4 years. And really the only savings measure in here is the government committing to capping real spending growth to 1.5% over the forward estimates, which is sort of what they've been doing over the past couple of years. So yes, there will be spending growth, but not too much above inflation. Moving on to some personal tax information. Now, basically, there's no change to these tax rates, but they mention it in the papers. So just putting it out there, essentially, they're reaffirming what's going to happen. Really, the only change here is in the tax bracket between $18,200 and $45,000, where we're decreasing over the next few years from 16 to 15 to 14%. The other tax rates are basically staying the same. So, like I said, that's really just more of a refresh as to what we've got. Now, what was announced in the budget last night is individuals will receive an instant deduction from the 2027 financial year, which basically means that everyone gets a $1,000 tax deduction without receipts. If you want to claim more than that, then you still have to have receipts. There's also this notion of a working Australians tax offset, which will apply from the 28 financial year. And basically, it's a permanent $250 offset that is applied to everyone on an annual basis, which effectively increases the tax-free threshold by $1,800, just the way the mechanism works. So both of those are, I suppose, a fair lead time. So from an individual, the 27 financial year, you're not lodging those tax returns typically for another 12 months. And the WATO, I think they're calling it, will be another 12 months after that. So I think they've deliberately done this as I'll call it an anti-inflationary measure, but trying to make people feel a little bit better about themselves, given the uncertain economic times at the moment. Getting onto some of the big changes within this budget. So firstly, on negative gearing. So basically, negative gearing is where you invest in an asset, an income-producing asset as an investment, and it creates a loss because the expenses are greater than the income it derives. Now, typically, you're doing this as a form of wealth creation because you're hoping with the intent that the asset goes up in value over time, and then you realise it and you pay tax on that. Now, basically, they're making changes to negative gearing, but they only apply to residential properties. So this is essentially pitched at the housing shortage that currently exists for I suppose younger Australians. As someone in the Middle Ages, I can say that now. Now it only applies to individuals, partnerships, companies, and most trusts. So not managed funds or widely held trusts, and not super funds. So it's important to note, super gets a carve out. Excellent. Transitional arrangements for existing properties do apply. I'll talk about that in a tick. But the thing to note is that basically it's only going to apply, negative gearing, will only apply to new builds of residential property going forward. So while you still can buy a property today and negatively gear it, it's on a bit of a time lap. So in other words, it'll run, your ability to claim deductions will stop, or certainly will diminish, I should say. So if we have a look at what those transitional arrangements are, basically, if you've already got a property before last night, there's no change. You're exempt from changes, so you're winning. However, this is specifically mentioned in the budget papers. In practice, the benefits to existing investors from these transitional arrangements are not expected to continue indefinitely. So heads up, that will change. So basically, they're putting everyone on notice that while they're not going to do anything in this budget, future budgets most likely will. If you purchase a property from today, then you can only claim the losses against the actual income. So you can't offset the losses against other income. However, you can carry forward any excess losses to offset against future property income. So that's a big distinction between what's been previously. So essentially, negative gearing to offset your personal, call it your wage and salary income, is no more if you want buying a property from today onwards. From 1 July 27, you won't be able to negatively gear at all, other than if you already had a property in place. So the ones purchased before last night, unless it is a new build. So that's the carve out there. New builds, you can still negatively gear to the same extent as what you can now. So what they're trying to do is essentially push investors into doing new builds, and which is aiming at increasing supply. Now, there are some interesting little definitions around what a new build is. You can't buy a property, demolish the house, and rebuild a house. There has to be a change in the number of dwellings on that land or something along those lines. So before you do anything in that regard, I'd strongly suggest you reach out to your Vincents advisor to talk to them around your specific circumstances, because everyone will likely be different in that case. And now I'm going to hand over to Belinda to go through the wonderful capital gains tax changes.
Thank you, Brett. And thank you to everyone who's taken the time today to join us. We have, as I'm sure you now know, just a few minor changes to our tax system, which I'm going to run through. As Brett alluded to earlier, the Treasurer told us that this was a reform budget. I'll admit most of the changes I'm talking to are just tax increases, but I'm going to do my best to remain optimistic as I go through it. And of course, as Brett said, I'm going to begin with the capital gains tax changes. So 50% discount is officially going. And just to set the scene for those not familiar with it, this general discount, it currently provides a 50% reduction to the assessable gain where you've held the asset for more than 12 months. Just quickly from a policy point of view, the government did acknowledge that some form of discount is appropriate. However, they considered that the 50% discount overcompensates some investors, for example, those in the real estate market, and that it undercompensates others. And they referred to their, shareholders in listed companies. They had some modelling and data around that. The budget papers also made reference to the fact that the discount was originally meant to increase investment into the share market, but the reality is that it's actually decreased quite significantly since introduction. From 1 July 2027, the CGT discount will no longer apply to gains accrued after that point. Which sort of means that we all have 1 year to get ourselves qualified as valuers before we're going to have a flurry of hard work and then we'll be off for retirement. But more seriously, so the removal applies to all asset classes other than new residential property builds. So this means the discount no longer applies to all real property classes. It no longer applies to share portfolios, and disappointingly, it also goes for business owners who are selling out of their business. Startup entities who, rely quite heavily on the CGT discount benefits to attract talent, through their offering of equity-based compensation, they're also massive losers here. They're going to lose probably one of their only trump cards that they have in terms of obtaining access to talent and access to capital. So I guess now we have a situation where the government is effectively a co-investor in any business going forward. The lack of differentiation, I feel, between the passive capital and productive capital has been very heavily criticised, and possibly rightly so. This would have perhaps been a real opportunity to incentivise people to take risks, to innovate, to do all the things that the Treasurer spoke about in his budget, and to build the economy. So perhaps a missed opportunity. Just mechanically speaking, so gains up until 30 June 2027, they're going to be grandfathered. So on realisation of an asset post 30 June 2027, there'll be two components to your CGT calculation. One where the CGT discount is applied and one where indexation is applied. In terms of determining the value at 30 June 2027, there are two options. The first is to obtain a valuation, which of course is why all the valuation qualifications are going to be the current version of a winning lotto ticket. And the second is to use an apportion method, which will be provided by the government. There aren't any further details on that apportionment method at this point, although there are similar methods within other areas of CGT, such as the primary residence concession, which are effectively just time-based apportionment methods. Currently, the CGT discount only applies to individuals, trusts and partnerships, and the new changes also look set to apply in the same way. So companies that have not, companies obviously haven't had access to the discount in the past, and it looks like they're also not going to get access to the indexation provisions either. So they're in the position where they have as their only recourse indexation, which was capped at 1999 levels, which doesn't necessarily make any sense. Just to illustrate graphically, so where the asset is disposed of after 1 July 2027, so part of the gain is subject to the discount. Part of the gain is subject to discount, part of the gain is subject to indexation. The original cost base is to be used for the calculation of the discount component, and the new cost base is to be set at 1 July 2027 for the indexation calculation. So that's, as I referred to before, either that method that a valuer provides you or calculated using the apportionment method, although presumably that's a sort of a calculation that cannot be done until the actual sale itself. There's no clarity around how, for example, like sale commissions or disposal costs would be treated for cost-based purposes, which cost base does it fall into? So details like that will obviously need to be worked through. This is obviously going to add complexity. The rationale that the government gives for splitting the calculation in this way is to minimise the disruption to asset markets and prevent the hoarding of assets, which obviously could otherwise apply if you grandfathered the discount the whole way through. Somewhat sneakily, pre-CGT assets are now also no more, or at least to an extent. So up until this point, the gain on a pre-CGT asset was not subject to CGT at all. But going forward, gains accrued on these assets up to 30 June 2027 will remain pre-CGT and not subject to CGT. But gains post that date will fall within the indexation regime. And the same mechanism for the setting of cost base will apply as with post-CGT assets. That is, you get the valuation or the apportionment method. And presumably the same issues as to cost-based composition may also apply. So the other major change to the capital gains tax is the setting of a minimum rate of 30%. The purpose of this, it seemed, was to deter the deferred realisation of capital gains until the asset holder was in a lower income tax bracket. I guess it follows through on the government's desire to tax passive income at the same rate as employment income, and it marries up with the 30% tax rate that's to be applied to trusts, which I'll speak to in a moment. Just at the moment, this measure is a bit light on detail, and particularly around whether it only applies to gains accrued after 1 July 2027, or whether it's going to apply to the gain in full. And in doing so would somewhat overrule the CGT discount. So there'll need to be further detail around this. Okay, on to business taxation more generally. And starting, of course, with the changes to discretionary trusts. So these are significant, to say the least, and are designed to curb the perceived use of this type of vehicle to allow taxpayers to reduce assessable income. Obviously, they give the ability to split income. The budget papers talk a little bit about the, I guess, the rationale for the change. They noted that the use of discretionary trust is primarily driven by the wealthiest 10% of the population, and that over 95% of Australians don't receive a trust distribution. I think in reality, there's plenty of discretionary trusts in the SME sector, and so there's perhaps a distortion between what the government thinks the numbers are and what the actual reality is. Certainly, this is going to massively impact any business that's currently operating through a discretionary trust. Just to, I guess, recap on the current treatment. So currently, discretionary trusts do not themselves pay any tax. Rather, they make a distribution to the beneficiaries of the trust, and those beneficiaries include that income in their return, and they pay tax on that at their marginal rate. So from 1 July 2028, so we have a little bit of lead time on this, 30% minimum tax on income of the trust is going to be payable by the trustee. So the trustee will make distributions to beneficiaries who will then include the income in their return, and they'll be assessed on that at marginal rates. But the beneficiaries will also include a credit for the tax paid by the trustee, depending on what type of beneficiary you are. So in essence, the framework sounds a little bit similar to our franking system, but there are plenty of traps. The first one, and certainly probably the biggest one, is that the budget papers really clearly say that the credits are available to beneficiaries other than corporate beneficiaries, which on the face of it suggests that if you have a distribution that goes through a trust up to a company, on the face of it, the effective tax rate on that now is around 53%, so highly unattractive. There's a separate question around the ability to flow franking credits through the trust with these new changes. So this is in the instance where you have a trust which owns a company as opposed to a trust distributing to a company. And there's potentially the same issue there with effectively the double taxation. The credits that the trustee will generate through the payment of tax are non-refundable. So individuals whose marginal rate is below 30% are going to be in a substantially worse position. There's no further detail on how the excess credits will be treated. So for example, whether they can be carried forward, whether they convert to losses. So certainly a bit of a gap there. Another element to think about is the order of application of the credits. So in particular, with respect to credits that are refundable. For example, your PAYGW credits, depending on the order of application, it can make a really significant difference to taxpayers on lower marginal rates. There's also questions, I guess, around whether streaming is still available. And also, probably more concerning is there was no clear discussion around sort of the carve out of CGT assets. and obviously the grandfathering of the CGT assets, whether that continues to be applied in the trust now that there's this flat 30% rate. Also query treatment of pre-CGT assets as well within trusts, certainly for primary producers. They quite frequently hold the land that they operate in within a discretionary trust, and a lot of that land is still pre-CGT. So it'll be a massive impact for them if the changes come through as they seem they might. There are some carve-outs for the new regime. It won't apply to fixed or widely held trusts, although there's a whole different conversation about whether discretionary trusts are actually fixed, whether any trust can be a fixed trust. Complying super funds are also excluded. There's certain disability trusts, deceased estates, and charitable trusts all also excluded. The rationale there being that those trusts don't tend to allow the income splitting, which is obviously what the government is concerned about in this particular case. Certain types of income are also excluded from this 30% rate. So examples include the primary production income and amounts that are otherwise subject to non-resident withholding. I don't see how this doesn't create a complete administrative nightmare for discretionary trusts that have mixed income sources. So, for example, farm and off-farm income. These trusts, may effectively need to keep two P&Ls, and they're going to be applying a different tax treatment to both of those P&Ls. I mentioned, obviously, of course, the land being held in the trusts. Sale of land is, of course, not going to be primary production income either. All these changes are, I guess, against a backdrop where both the government and the ATO have made the use of discretionary trusts increasingly unattractive. The budget papers do recount sort of the history of legislative change in this area, and there's a fair bit over the past sort of 10 to 15 years. But that's obviously also overlaid by the ATO's interpretation of quite a few of these measures. The family trust elections, the 100A interpretations that the ATO have put out have almost made discretionary trusts unworkable. And it's so difficult to comply with the requirements and get right. I think if you take a little bit of a cynical view to all of this, it seems that the government's response to dealing with the complexity that's being created around discretionary trusts is just to sort of make sure that no one uses them anymore through these changes. One small shining light, and likely in recognition of all what I've just said, there will be expanded rollover relief for small businesses and other taxpayers to structure out of trust arrangements. There's almost no detail provided on that, however. Couple of queries. Whether the trust needs to be carrying on a business. Most of our current rollovers do require a business to be carried on, so that would certainly be problematic. Not all discretionary trusts carry on a business. The reference to other taxpayers, what does that entail? Whether it's they've said it's going to apply to small businesses. So what is a small business? Generally, at the moment, the threshold for a small business is aggregated turnover of below 10 million. And so there's a lot of businesses that are above that that are now going to find it quite hard to restructure. Just, I guess, as a general comment, if this proposal proceeds, hopefully, fingers crossed, it will be one of the first things addressed with legislation so that, taxpayers can determine their path forward early. There are so many hurdles to restructuring commercially, which I think appears a little bit lost on the government. And of course, a lot of state revenue authorities no doubt licking their lips at the potential revenue that's going to arise from moving businesses out of a trust structure. A lot of the states not providing any form of relief. Hopefully they will come to the party to enable these restructures to take place. There is a closed window on the restructure relief. So you have a period which opens on 1 July 2027 and it's going to last for 3 years. So that's your window to restructure. It also means that if you wanted to move early on this, you can't. You need to wait till 1 July 2027. So I think fair to say that there's a few tough years ahead for discretionary trusts. Okay, moving on. So something positive coming through is that the loss carryback will be reintroduced for companies. So some of you will recall that we had a loss carryback during COVID. So that ended in the 2023 year and was quite a successful measure in terms of stimulating the economy. The new carryback is proposed to be permanent and it will allow corporate taxpayers to carry back losses for up to 2 years. It does appear to be introduced in response to concerns around the short-term losses from the current global economic impact. The budget papers refer particularly, obviously, to the oil issues that are going on. But I guess the permanent nature of it is a real upside. It will certainly help, a lot of taxpayers. As I said, it does only apply to corporate entities and the entity needs to have turnover below $1 billion, which is obviously a pretty high threshold. It applies from 1 July 2026, so presumably entities which make a loss in the June 27 year, they can carry back to tax paid in both June 2025 and the June 2026 years. As with the COVID period loss carryback, the amount you can carry back will be capped at the franking credit balance of the entity. So where you've paid out franked dividends and then made a loss, you may not be able to carry those losses back in full. Running hand in hand with the loss carryback is going to be a new loss refundability for small startup companies. So this is a completely new initiative. It's going to apply to entities which have aggregated turnover below 10 million. And they are within the first 2 years of their operation. So it's a very small window to claim this. The refund applies from the 1 July 2028 year, so a little bit of while before this comes in. And it's capped at the amount of FBT and PAYGW that's been paid by the entity. So it's effectively just giving you back some of the tax that you've paid. Okay, small businesses more generally, and there wasn't a lot in there for them. In fact, given the changes to the discretionary trust rules, budget was a bit of a disaster for them. In terms of the measures specific to small business, thankfully the instant asset write-off has been made a permanent feature for those small businesses. So this will allow businesses with aggregated turnover below 10 million to immediately deduct assets costing less than $20,000. And there is obviously an opportunity to take advantage of the interaction between the instant asset write-off and the loss carryback, as there was during COVID. There will also be some expanded access to monthly instalments for taxpayers who, if you feel like paying your tax sooner, I'm sure they'll be of great benefit to you. However, for those who have a history of non-compliance, they'll now be required to pay their instalments monthly. So a bit of a crackdown there, which follows on, I guess, from the ATO's crackdown in general in terms of trying to recover payments. They still have a tremendous amount of debt owing, and they are taking a much harder approach on the recovery of that. There is also a trial underway within the ATO to make the calculation of PAYGW instalments more dynamic, which is to be sort of rolled out in a pilot through the software. I think the idea being that, you can vary more frequently with less penalties if you sort of get it wrong when you look at the liability at the end of the year. So certainly that would be of some assistance. Okay, moving on to the R&D tax offset. And I guess keeping in mind, the Treasurer's comments that this budget was about innovation and about really incentivising development and R&D in Australia. So some really fundamental changes for businesses claiming the R&D offset. Some positive and some negative. Just to provide a little bit of flavour, the R&D tax incentive is Australia's biggest concession to promote R&D within businesses. I guess it's therefore a little surprising that the budget indicates that they're expecting to save $650 million over the forward estimates from these changes to the R&D tax offset. So I guess reading between the lines, this means that our biggest tool for innovation promotion is about to provide less support than it currently does. So we'll see how that goes with the innovation budget. To start with the good, and there is some real good here. So the refundable offset will now be available to businesses with turnover up to 50 million. So that's increasing from businesses with turnover below 20 million. And that was certainly in my experience, that turnover threshold was a bit of a sticking point with some taxpayers as to whether they would claim whether they got the refundable amount or not. So that uplift in the threshold is really encouraging. Obviously granting access to the refundable amount to a larger section of the innovation community. Also positive is the change to the headline rate of the offset. So it increases by 4.5% across all types of claims. For businesses with turnover below 50 million, the rate is going to move from 18.5% to 23%. And for larger businesses, they have a split rate. Which depends on the intensity of their R&D. So the low intensity R&D activities, the rate will move from 8.5% to 13%. And for high intensity activities, it's moving from 16.5% to 21%. The intensity rate being measured by the level of your R&D expenditure as a proportion of your entire expenditure, business expenditure. Finally, the maximum expenditure threshold has been increased to 200 million, up from the current setting of 150 million. This has supposedly been driven by declining rates of R&D within larger entities, although in practice, I suspect that there's a fairly strong argument that that decline is also due to the ATO's sustained attack on R&D claims over the past 10 or so years, as opposed to any commercial decision not to pursue R&D. The bad news, and there's a little bit of this as well, and it's sort of predominantly borne by the smaller entities. So supporting expenditure is now no longer eligible for the offset. So there were two types of expenditure: core expenditure, which was, I guess, in relation to the actual R&D activities themselves, and then there was surrounding that some supporting expenditure, which you could also previously claim. So there's no more claims for supporting expenditure. It's now only expenditure on the core R&D activities that form part of your claim. The refundable offset, which I referred to earlier, which is a massive incentive for those companies which can get it, it will now end 10 years after the entity was incorporated. Previously, there was no time limit on the claiming of that refundable amount. So that's going to take the offset, the refundable offset, away from entities which are doing, long-term ongoing R&D. Finally, the expenditure threshold for claiming the offset. So you'd have a minimum sort of R&D spend to be eligible for the tax offset. So that's increased to $50,000. It was previously $20,000. So obviously a bit of a jump there in order to access the concession. The rationale behind that was that they felt that there was some perhaps not so legitimate claims in these smaller entities, and so they've bumped the threshold up, I guess, in an effort to combat that. Whether that's true or not, I guess remains to be seen. You can claim expenditure below the 50,000 threshold, but where it's undertaken by registered R&D organisations, which I guess is, in the government size, legitimate R&D spend. Just for those who are claiming the R&D offset, please feel free to reach out to your Vincents advisor to discuss this. We do have R&D specialists within the firm who'll certainly be able to talk through how these changes might impact your claim. Okay, so venture capital changes, and I guess this is also trying to fall under this idea of promoting innovation. So a couple of changes proposed here. Australia, we do have existing offsets for taxpayers investing into these entities. However, in my view, they're generally fairly poorly understood and they are difficult to access. So maybe just by way of explanation for those not familiar, the early stage venture capital limited partnership concessions. So they're aimed at encouraging investment in startup and early stage businesses, and they effectively work through giving, pooled investment vehicles concessions. So those pooled investment vehicles will invest in various startup companies. So investors into the investment vehicle, they generally receive a tax offset equal to 10% of the amount that they've invested into the fund in the year that they invest it. And the funds themselves, which are obviously out there acquiring and contributing to and funding the early stage entities, they themselves receive some quite significant tax concessions. In some circumstances, the gains are completely exempt from CGT. I guess sort of combating those good concessions is that there are quite strict requirements around the types of investments that a fund can hold. VCLPs are sort of a similar idea. They're more aimed at foreign investors, and they also receive some significant CGT exemptions on the disposal of assets. So the budget changes are primarily aimed at the qualification criteria for the assets that these funds invest into. There doesn't appear to be any changes to the actual tax concessions themselves. With regard to the early stage venture capital limited partnerships. So these funds can now make initial investments into entities with assets up to 80 million. So previously they were capped at initial investments into entities that had 50 million or less than assets. And venture capital limited partnerships, their initial investments can now be in entities with assets of up to 470 million. So they've just widened, I guess, the eligible investments in that regard. Investors can retain the access to the concession. So the investing entities themselves can retain the access to the concessions for longer. So previously, once entities got to a certain size, as a general rule, the funds had to divest those investments. They were considered too big, no longer sort of startup entities, so they had to sell out. So they've upped some of the, the divestment point requirements, effectively increasing the assets from 250 million to 420 million. There was a report done, I think it was last year, just around some of these suggestions. So these changes made by the government follow on from that report. Admittedly, the report suggested higher caps, but this is where we've ended up. There's also an increase to the maximum capital that an early stage venture capital limited partnership can raise. So while all of that sounds very encouraging and certainly would on the face of it help with the innovation agenda, the expected expenditure on that measure is only $10 million over the forward estimates, which I guess indicates that Treasury probably doesn't think it's going to have that bigger impact. Just quickly, international, I feel like the last 5 or 6 budgets have been very heavily focused on multinational groups and around tax avoidance there. Very little in this budget for international groups. Just a couple of quick points to let you know. So there's the ban on foreign investment in established residential housing. So that will be continued. There have been some transitional arrangements announced for the changes to the non-resident CGT regime, which were announced, I think, late last year, some quite fundamental changes there. And there's also some sort of guidance materials for the entities which are going to be subject to BEPS, so the base erosion and profit shifting rules. That's for groups with sort of global turnover well above $1 billion. So not a lot on that front in this budget. And with that, I will hand back to Brett, who's going to talk about super or not.
Yeah, thanks, Belinda. And look, I'm sure that now, as everyone can well appreciate, there's been a little bit of change in the tax world, or I should say proposed change, because basically what they've announced last night is not law yet. It still has to go through the relevant lower house, which will happen, and then through the upper house, the Senate. Now, basically, as of last night, the Greens indicated they would be supporting essentially all of the tax measures, but that was really before they saw the details. So we'll see how that plays out. But at this stage, not law, but probably will be. So in relation to the super changes, there was none. Isn't that awesome? And look, I skeptically say that because it took them 3 years to get the Div 296 tax passed through Parliament, they essentially came up with at least 2 iterations of it. They just went, you know what, super's all too hard. We're not going to do anything. Though that being said, they've thrown a little bit of money to redesign or to refine a reporting or a report card measure that's in place, where basically the government is comparing how the super funds are performing. So that way individuals can see how, if they're in the right fund and if they should change, and if the poor ones get a big smack on the wrist if they continue to be poor. Personally, I have a real objection to this, and I think most financial advisors do as well, because all the government is doing is essentially incentivising the trustees of those super funds to take on more risk so they're not at the bottom of the pile. So a balanced fund, which you think would be 50% income, 50% growth, the reality is they're about 70% growth, 30% income, which that's not balanced. So people are actually superannuants are taking on more risk than what they actually think they are, which I don't agree with. It's not right, but I'll get off my high horse again. So no changes for super. Yay. So to give poor Belinda a bit of a break, since she's had all that other stuff to go through, I'll just briefly touch on some of the other measures that were in the budget. So we're spending $14.8 billion on a fuel resilience package, which basically is going to increase the fuel reserves in Australia. I think we're meant to be 30 plus days. They want to increase it to 50 plus days. And I'm presuming that what will happen is that rather than those reserves sit in another country, such as the US, they will actually move them onshore. But that's just a presumption. 20% of all LNG gas exports will now be reserved for the domestic market from basically the 27 financial year. So, and rather than exporting all of our gas, they'll have to keep some put aside. They also have allocated $1 billion for an economic resilience program, which is basically providing interest-free loans to those that are involved in manufacturing and logistics businesses. So this is to help with the call it the fuel shock. So that way those businesses can obtain an interest-free loan to then invest in either alternative technologies or whatever it might be to electrify their fleet or their machinery. And there's also $1.1 billion set aside for an investment through a cleaner fuels program, which is essentially developing low carbon fuel. Belinda and I were talking late last night, and I commented to her that Formula One, that I'm a fan of, is doing sustainable fuels in their cars this year. And this is essentially what I think the Australian government is wanting to invest in, where we're not going to be as reliant on fossil fuel energy for our machinery, looking to do low carbon and perhaps even more sustainable fuels in that regard. There were also some changes to the electric car FBT discount. So currently there is a full FBT exemption. So FBT is fringe benefits tax. So there is a full exemption for electric vehicles. From 1 July 2027, that full exemption will only apply to vehicles under $75,000. And for vehicles from $75,000 up to the luxury car tax threshold, the FBT will be will have a 25% discount. And from 1 July 29, the permanent 25% FBT discount will apply to all electric vehicles. So essentially, they're decreasing the incentive for people to get into electric vehicles. And I thought this was just a little bit of fun, that the government has put aside $40 million over 4 years for a rollout of EV chargers in rural black spots. So I'm presuming that would most likely mean around the national M1 roadway. They're going to put some EV chargers in, so that way you can make it the whole way around. And also $40.5 million to give to Australia Post, so they can accelerate the electrification of their delivery vehicles. So soon the posties won't be on their little petrol motorbikes, they'll be on electric scooters. So it's always a bit of fun to find things like that in the papers. And finally, there's obviously been a lot of talk about data and AI, artificial intelligence. So the government is putting together an accelerator program, so just $70 million in 26 and also again in 2027 to help businesses transition for a AI approach. They've also launched a new website, which is ai.gov.au, that is to be the trusted practical resource to help organisations plan and use AI responsibly. There's going to be a AI-enabled digital tool to improve the use of the National Construction Code. So rather than builders having to buy the current building or National Construction Code and the building standards, they'll be able to just essentially obtain them free of charge through AI mechanisms. And also an aligning of data centre investments with Australia's national interests by setting expectations for data centre developers. So basically putting some safeguards around data centres, presumably where they're located, their AI, their energy resourcing, that sort of thing. And also mentioned was the government doing some partnerships with Anthropic, and I think it was Microsoft in the AI space. So I think the government is moving AI forward in their own internal agendas, if I can put it that way. And we're done.
Yes, we are. Thank you, Brett. I feel like we've gone through a lot there in a relatively short period of time.
Oh, Belinda, you've done a lot of heavy lifting in this budget, I can quite assure you.
Let's hope that it was all to no avail and they don't introduce any of it.
I think that's called wishful thinking.
There are a few questions in the chat, which let me just have a quick look. So there is a question or just around downloading a copy of the webinar, and I'm sure we will be able to do that. And I think perhaps a recording of it will get circulated afterwards.
Yeah, we normally put it up on YouTube, I think, as well, Belinda.
Yes, perfect. Okay. I don't think that there are any other questions coming through. So given that, we'll finish off a little bit early. Again, thank you everyone for joining us. Hopefully you found the session of use, and now have quite a few things to think about. Obviously, there will be some big changes over the next months and years. Please reach out to your Vincents advisor, as and when suits you. And I have no doubt that they'll be in contact with you anyway, just to speak through some of the options that might be available. At the moment, we're obviously a little bit detail light, so there'll be more discussions as we get some more information through.
Yeah, the devil will definitely be in the detail with this budget.
Yeah, absolutely. So thank you everybody again for your time, and enjoy the rest of your Wednesday.
Thanks very much.